Welcome. This is Francesco Nagari, Deloitte Global IFRS Insurance Lead Partner. I am taking you today through the webcast that will describe the events of last week within the International Accounting Standard Board and their project on the delivery of the first comprehensive IFRS on insurance contract, the project known as IFRS 4 Phase 2. The title of today's webcast is Progress Towards Finalizing IFRS 4 Phase 2 Slows Down. Continuing education on participating contracts and decisions on PAA. As always, our agenda is structured around three items. First of all, I'll give you the highlights of the discussions about participating contracts at the ISB meeting last week. Then we'll have a deep dive on the ISB staff recommendations and what they actually proposed to the ISB and what was the response from the ISB, and particularly whether they agree with them and the vote. We'll also spend a few minutes at the end of this presentation to look at the next steps and give you an update from a Deloitte perspective on the timetable to completion of this project. The ISB meeting was held on the 23rd of September 2014. It is now a meeting which is no longer attended by the FASB board members, as the joint project was terminated in February. And it was divided in two parts. The first part, where the ISB staff took an extra session to educate the board members about the accounting adaptations to the model of insurance contracts accounting in order to accommodate the participating features that are present in a very large number of insurance contracts around the world. The particular topic covered in this week papers was the accounting for the time value of money, and whether the book yield approach or the effective yield approaches are fully understood by the ISB and the staff, whether those methods can be developed into something that can live within the OCI solution that the board has already agreed for non-participating contracts, and how, in that context, the use of the particular technique called the book yield approach should be used for accounting for the time value of money in the profit or loss of an insurance company. You will see that the ISB was not asked to reach any decision at this stage, but just to give directional guidance to the ISB staff, which, on the other side, has done quite an extensive amount of work over the summer months. And I will take you through the various details that have actually led to a quite articulate and fairly comprehensive set of positions that the ISB staff is likely now to take forward to the what we hope is going to be the first decision-making session on this very important and final topic for the ISB in order to complete its redeliberation work on the new standard. Really is the last thing that remains, together with transition, because the only other topic that we highlighted was still up for debate, has now been decided upon, is the series of decisions on the premium allocation approach, the one on the revenue recognition pattern, and the second one on the determination of the interest expense discount rate when the OCI solution is adopted for those type of contracts. So let's have a look now in a bit more detail how each of these topics were presented by the staff and discussed by the board members. The first element of the educational session on the participating contracts around the time value of money was a couple of papers, paper 2A and 2B, where the ISB staff took the opportunity of owning, if you like, these two concepts. They explained to the board members, following up from the July discussion, that the book yield approach has been put forward by a number of constituents. Deloitte, in its global response letter, was one of those constituents. We proposed that as a driving to a different approach for P&L presentation of the interest expense from participating contracts, particularly when an OCI solution is adopted. Clearly, the ISB staff noted that the objective is a reduction of accounting mismatches between the interest expense that arises from the accounting of the liability from insurance contracts and the interest income that comes from the underlying items when those two are economically matched between each other. And so the first objective was really to define these two approaches. And you can see on this slide the method that the ISB staff believe is going to be their way of describing the book yield approach. It's a four-step method. First of all, the insurer would identify the underlying items that determine the policyholder cash flows that vary with investment returns. Second, they would determine the basis of the accounting for the return generated by such specified underlying items. Thirdly, they would construct a yield curve based on the book yield at each reporting date arising from those items and use it as the starting point for the determination of the yield curve that would produce the discount rates that the insurer would then use on the participating liabilities to account for the time value of money. Those rates that form this yield curve would be subject to the fourth and final step of the method, which is the adjustment to eliminate any differences that may arise on the initial recognition of a contractor. And that is an important point. For example, Deloitte, we didn't recommend that, but the ISB staff noted that it would be important to eliminate that in order to have an alignment with the balance sheet position. We were of the view that by just looking at the market value of the underlying items, you would have achieved that. This is just another way of achieving essentially the same accounting outcome, but using just a different logical construct for the process to be adopted. So this is the book yield approach that the ISB staff has now taken on board as their way of describing it and putting it forward for the decision-making session that we hope will start next month. In terms of the proposals around these methods, the staff said that they would actually consider a book yield approach only when it minimizes accounting mismatches with the underlying items. And they've started to build a series of rules. That's where, for example, from a Deloitte perspective, we wouldn't be necessarily in alignment with the staff proposals because we felt that it was not supposed to be constrained by any particular point other than being applicable to a precise scope that captures the participating contracts. And to some extent, the ISB staff adopted that principle, but then elaborated that further. And you can see here that the staff is proposing the book yield approach would be prohibited whenever the underlying items include equity investments measured at fair value to OCI and or investment properties that are measured at cost with a policyholder participation mechanism that shares with the policyholder any capital gains realized on sale of those investment properties. So this is, if you like, restricting the use of the book yield when underlying items are accounted for in those two particular ways. And in the second instance, there is a particular form of participation that makes the policyholder community share into the realized gains and losses on investment properties. Apart from those two instances, the book yield approach would be permitted in all the other instances, and those will include any form of accounting applicable to bonds, whether they are government bonds or corporate bonds, it doesn't matter, as long as they are debt instruments. They can be accounted for amortized cost, fair value to OCI, or fair value to P&L. It will still be applicable, with the one condition that should be easily met by the insurance company preparers, which is that the expected credit losses on the bonds must be part of the book yield calculated discount rate curve. The second is that if the investment properties are accounted for at cost and the policyholder participation is only restricted to the rental income generated by those investment properties, then the cost basis for the investment property accounting would not trigger any prohibition. And so here you can see that the cost basis in itself, as permitted under IAS 40, is not per se a barrier to using the book yield, but the book yield would be prohibited if the participating mechanism includes realized gains and losses. If equity securities or investment properties are accounted for at fair value to P&L, then there is no restriction. You can still apply the book yield approach alongside bonds, for example, at amortized cost or fair value to OCI. So the mixed measurement basis is not necessarily an obstacle, subject to those conditions applicable to equity securities and investment properties. This approach, according to the staff own analysis, would ensure that at inception of the contract would generate a yield that is actually not aligned with the current accounting yield, the book yield of those underlying items, but it should be adjusted such that the book yield on initial recognition is effectively anchored to the fair value of those underlying items. In that way, the balance sheet and the P&L derived balance sheet figure would be the same on day one, which is a fairly understandable point of view, and the one that in a different way we did support in our Deloitte response letter at the time. Moving then to the effective yield approach, here the staff continued to elaborate further on the discussion that they had with the board in the months before the summer recess, and pointed out that they have been considering essentially two variations of the effective yield approach, one called the level yield method and the other one called the projected crediting method. So let's have a look at how those two methods have been defined and the conclusion that the ISB staff reached. In terms of the first variation, the level yield method, it is effectively substantially the same approach used for financial instruments under IFRS 9 for amortized cost calculations, because it is indeed a single rate which operates the mathematical internal rate of return calculation of equalizing to zero the future cash flows to the initial one that is received from the policyholder. These calculation, given that those cash flows will actually change as the current measurement of future cash flows reflect the new updated view as to what their amount is going to be, will have to be reset at each reassessment of the future cash flows, in the same way as a financial instrument with a floating interest rate will have its amortized cost effective interest rate reset at each point in time. Think about a floating LIBOR-based financial instrument. Whenever the LIBOR is reset, the spread is recalculated to again reproduce the same effect of the interest rate, internal rate of return interest rate that discounts down to the carrying amount, the future cash flows. The same approach would apply to insurance contracts if this method is adopted. The second variation is an effective yield method, effective yield approach that uses a projected credited rate. This calculates discount rates on a basis that reflects the insurance company's projected crediting rate. So it's an input that already is part of the balance sheet measurement of a participating contract liability. If I can take the opportunity to remind you that since 2010, the ISB is requiring for the projected cash flows of participating contracts that each future bonus declaration must be included in the current estimate of future cash flows, both for the current existing policyholders as well as the future ones that may become participating policyholders from the same fund at a future date. So there is a continuum of projected bonuses declarations and policyholder dividends declarations that will be part of this estimate, and this level of actual crediting rates that are forming part of these estimates should be also used, according to the staff, as an alternative way of looking at the book yield approach for insurance contracts with participating features. Having explained how they would actually like to define them from an ISB perspective, the ISB staff also took the opportunity to express their future recommendation that as far as the effective yield approach is concerned, they would take the latter of the two methods, the two variations, as their preferred description of the effective yield approach. So we will have, going forward, a book yield method described in the terms that I presented to you today, and an effective yield approach which is going to be based on the projected crediting method. The reason for this choice is that they believe this method has got the ability to reduce mismatches between investment income and interest expense when there are changes in estimates, and also they felt that the interest based on crediting rates would be closer to an incurred cost view of the interest expense recognized in financial statements, as well as being more likely to mirror the investment income when it is accounted for on an amortized cost basis. Having reached their conclusion on how to describe the two methods that will be used for time value of money, the ISB staff then moved on into generating a bit of a debate around it, and the salient points that we captured are summarized on this slide. You can see that, first of all, Stephen Cooper took the opportunity that he has expressed in his dissenting view comments on the exposure draft last year, that if OCI is used, that will not be an acceptable position from his perspective, and it would be better perhaps to consider the unlocking of the shareholder share of the CSM in order to reflect within that the effect of changes in discount rates. It was noted, but clearly that is one of the most, if not the most, controversial issue, and it remains to be debated in the proper decision-making session. So at this stage, there was nothing further to add from the debate we observed. There were questions from some of the board members as to how many insurers would actually use the book yield approach, given that there is an ample opportunity for them to designate financial instruments at fair value to P&L. Another point we observed is that insurance liabilities often extend beyond the duration of the backing assets, and that is in itself a very good reason for the OCI to be a preferable accounting treatment than fair value through P&L in many instances. And this approach will actually avoid distortion on the profits being reported. Some of the ISB members actually expressed views in support of the book yield approach because they felt that this actually addresses the elimination of accounting mismatches in a very effective way. Concluding comments from the staff, which we felt was worth sharing with you, is that they are at this stage still looking at potentially using the book yield approach as a method that could be compatible with both an OCI solution and one without it. We'll see later on that from their perspective they already have a view, and their view is not really as open as they pointed out at this stage of the debate, but they are just the staff, they are not the decision makers in this process, and it is up to the board to make up their views, and so the staff diligently pointing out here that they would still consider both scenarios in the debate to come. On the effective yield approach, the key points from the debate are that the staff confirming that the underlying items were not restricted to asset returns, but also included in this particular instance variable returns like mortality gains and cost sharing mechanisms, making it easier in that instance and potentially superior in the eyes of the staff to the book yield approach, given that it would actually overcome the absence of those contributing factors to the declaration of the bonus from being an observable item on the balance sheet of the insurance company. The second point is that some financial assets would actually be accounted for at fair value to P&L because of the characteristics of the instruments under IFRS 9. And therefore, the use of the effective yield method could create accounting mismatches because it would not be able to have an expense item in the P&L matched by an equivalent income from the underlying items accounting basis. And finally, the ISB staff in their paper noted a few possible refinements, which essentially looked at how to adjust the resetting mechanism around the effective yield to take into account the presence of realized gains and losses when the underlying items are accounted for under a mixed model. They actually concluded in their paper that they would not recommend them the refinements to the board because of the complexity they felt they would create. A number of board members were actually in disagreement. Others were in agreement with the staff, but those in disagreement observed that from their perspective, they felt the refinements were actually quite a good idea, and they would actually welcome them to be part of the effective yield approach if possible. And there is possible costs that didn't appear to be so onerous in the eyes of those board members to justify the staff position as reported in the paper. Having concluded the debate, the staff then moved the board discussion onto the next topic, which was the interaction of these two approaches with the potential OCI solution accounting policy. As you remember from the previous board meetings, webcast, we brought to you the news that the ISB has decided to offer as an accounting policy option the choice of adopting the OCI treatment on a portfolio-by-portfolio basis. So here the decision is to what extent the book yield approach and the effective yield approach would interact with the OCI solution when available. The ISB staff also explained that these adaptations are needed to the general model for participating contracts when the ISB believes that those adaptations should not be accounted for using either the book yield or the effective yield approach, and could be accounted for using the effective yield approach, but should not be accounted for using a book yield approach. Effectively, it's a bit of a matrix game here that the ISB staff wants to play, a matrix that we'll present to you in one of the next slides, but not before having actually completed the overall jigsaw by explaining that this matrix must be taken into account a new set of criteria that the ISB staff put forward, which would split the universe of participating contracts in two components. One that is associated with the underlying items being held as a requirement, either contractual or statutory, and another subset where those requirements to hold the underlying items actually are not in place, and there is just an economic utilization of the underlying items present in the balance sheet of the insurance company to fund the benefits to the policyholders, but without actually having necessarily the need to hold them for any particular time. And in fact, those benefits could be funded out of other resources of the insurer. That is an important economic difference, and the ISB staff decided that they should actually look at only the former subset as the one where the book yield approach would be permitted to be used. So we have now, if you like, a number of factors that are playing into this game of standard setting, and we have formulated the various combinations into this table. It's not one that the ISB papers will present to you, so it's a Deloitte interpretation, bear that in mind. There are effectively 9 possible combinations, and the 2 dimensions that we need to take into account are: the first one on the columns is the type of participation that we are looking into the contract, and we have effectively 4 possible situations. The first one is the one that we already talked about in the past, is absence of any form of participation, so non-participating contracts, simply because there is no way that the policyholder will be entitled to share into the returns of any of the assets of the company. There is a new category that will still be classified as non-participating contracts, and that is the category of contracts that still have a form of participation present in the terms and conditions, but that form of participation is not one that provides the policyholder with a substantial participation into the underlying items. So we have now a new test to be introduced here, which is the degree of participation. If it is not substantial, you are not treated as a participating contract under IFRS. You will be pushed out into the non-participating column of the table, and you will receive the same treatment as if you have no participation whatsoever in the underlying items. But if you do have a substantial participation in the underlying items, then you need to analyze the conditions under which the insurance company is under as to the requirement to hold those underlying items. If there is no requirement, then it's a subset, and if there is a requirement to hold them, then it's a separate subset. And those two subsets will have a difference as we analyze the three possible alternative bases for accounting for the interest expense in profit or loss. So the first one is the locked-in discount rate set by reference to market discount rates, market interest rates at the inception of the contract, and then kept constant thereafter. Is a yield curve that will only apply to non-participating contracts and contracts without substantial participation. This is not permitted for all the other two types of participating contracts that I described earlier. Then there is a second approach, which is the book yield rate curve, coming from the book yield approach described earlier, not permitted to non-participating contracts, also not permitted to participating contracts where there is no underlying items requirement to hold them by the insurer. The only instance where this book yield approach is going to be used is for participating contracts where those underlying items are actually required to be held. And that gives essentially a much greater certainty to preparers and users and auditors as to the audit trail that exists between the book yield approach curve and the underlying items that are used to derive the curve from. Interestingly here, the ISB staff is proposing that there is a restriction for the use of this book yield rate curve only when the OCI solution is not adopted by the insurance company. So this book yield approach effectively is only available when you are booking the whole impact from the book yield through profit or loss. And then we come to the third possible calculation of the interest expense, which is the effective yield approach. As we know from the staff, is going to be a projected crediting method proposal, and that is obviously not permitted for non-participating contracts. It is required in all cases for participating contracts when there is no requirement to hold the underlying items, and it is required for the other subset of participating contracts, but only when the OCI solution is elected. So in other words, if you are in the third column, the one that is the extreme right in the table, you will have the choice. You can use the effective yield rate curve both under an OCI or a P&L approach basis, or if you want to use a P&L approach, as an OCI approach, you have then to abandon the book yield approach calculation and just present the interest expense using the effective yield rate curve based on the projected crediting method described earlier. So this appears to be a new sort of a framework within which the staff is now leading the board into, in what hopefully would be the first decision-making session next month. And it is a much clearer perspective, if you like, whether we like it or not, but at least has got the benefit of clarity. Most of the doubts that have been raised by the people that corresponded with me in the past several weeks appear to have been addressed by this framework, and hopefully the summary that Deloitte has put together can help you make sense in what was a fairly large body of papers presented last week. Coming to the description of what happened in the actual meeting, the salient points from discussion was again the point that Stephen Cooper raised, reminding the other board members that he still holds his view expressed in the dissenting pages of the exposure draft last year against the OCI solution altogether. Second point is that there will be an OCI accounting policy choice for insurance contracts, but there is less freedom on the IFRS 9 side in terms of the OCI. As you know, that's not a policy choice, is a test result from the business model assessment of how those assets are managed. Some criteria may be necessary to determine the most appropriate accounting policy for insurance contracts in order to minimize accounting mismatches. Now, the ISB already decided not to add further criteria from a non-participating contracts, but clearly those board members that voted against that decision came back last week and made that point again, given that the whole matter will be discussed now in the context of participating contracts accounting. The third point we observe is that if it was decided not to allow to use the OCI for contracts with participating features, then it would be necessary to do likewise for contracts without participating features. And an alternative tool at that point could be to allow for the unlocking of the CSM to be modified and include also the discount rate as one of the factors that could trigger the unlocking of that component of the liability. At that point, the staff confirmed that if the unlocking of the CSM was changed to include also the movements in the discount rates, then clearly that would make the use of the OCI a fairly redundant accounting mechanism in the new standard. So we'll see whether this particular point from that board member would be articulated in the set of papers for the decision-making session next month. That concludes my description and exposure on the educational session. So let's now dive into the two items which were covered on the decision-making part of the meeting on the premium allocation approach. The first one was the issue around whether guidance should be provided on the pattern of recognition of insurance contract revenue under the PAA. And the recommendation here was that ordinarily the accounting basis that was approved by the staff for the CSM should also apply for the PAA, which is a combination of passage of time and reduction of contracts over time. As they lapse, of course, the full revenue will be recognized as if the full CSM would be recognized in the building blocks approach model. However, the staff recommended that for PAA revenue recognition, there should be a further guidance to be added, which indicates that if there is a release from risk which is different from the passage of time, that pattern should take over the passage of time and be used instead as the most faithful representation of the service occurrence in the accounting of the PAA insurance contracts. The points from the discussion, including the fact that the staff stated that the guidance was needed in order to prevent diversity of approach and lack of comparability. There was also a point noted that if the value as well as the number of contracts was so relevant, then the language should be very clear in that regard, and the staff confirmed that they would make sure that this is the case in the final text that will be published. And finally, there were questions about what was meant by the transfer of services and whether this was limited to claims or also included other costs that are incurred over the duration of the contract and the standard obligation to meet the claims. And the staff confirmed that that was their intention, so claims handling expenses, for example, will be also taken into account. As the chairman called for a vote, all of the 14 members present unanimously voted in favor of the staff recommendation. The staff then moved to the second topic for voting, which is the issue as to whether the interest expense for the liability for incurred claims in the PAA should be set at the inception of the policy or whether perhaps another date should be chosen. And the recommendation was for the latter proposal, amending the 2013 exposure draft in that the staff recommended to the board to choose the incurred claims date as the date at which the interest rate would be fixed from a market rate perspective and the discount rate derived from to account for the time value of money through profit or loss for the claims liability. The key points noted during the discussion were first that the paper noted that if the rate of exception of the contract is used, catch-up adjustment should be recognized in OCI, which is true, and this OCI element would need to reflect the changes in the discount rates between the date of the contract inception and the date when the claim is incurred. Now, arguably, that may not be a big difference and may even be an immaterial one, but nevertheless, if you account for those contracts on a one-by-one basis, you may end up having to account for that, and so clearly that is theoretically possible accounting difference that you will have to manage if the inception date is selected. These adjustments, second point noted by the Deloitte observer, is that these adjustments may be difficult to explain because there are no gains or losses which would otherwise be separately recognized in the statement of a comprehensive income relating to any changes in the assumptions between the date of inception and of the contract and the date in which the claim is incurred, so leaving that floating OCI balance to be perhaps subject to some more questioning than it deserves to be. In the staff view, and that was the third point that we observed, came out from the debate, this adjustment would mean that if you use a discount rate locked in on the date other than the date of the claims incurred, you would only add complexity without really significant benefits. And so, given all these arguments, the staff felt that their recommendation was sound, and they expected the board to support it. And in fact, when the chairman called for the vote, once again, the board was unanimous. All the 14 members voted in favor of the staff recommendation, and so going forward, the locked-in discount rate, if you choose to use the OCI solution for your claims incurred liabilities, will be set at the inception of the date the claims is incurred, rather than the inception of the policy that generated that claim. That is the last of my points on the description, detailed description of the events of last week board meeting. So let's now spend a few minutes on the next steps. What are the remaining issues? Well, clearly now with the PAA being dealt with, it is just the participating contracts, and effectively the board has slowed down the pace. It was supposed to be a decision-making session already this month, but instead was another directional educational session. I think that we shouldn't be too concerned. A little bit more time spent on understanding probably the most difficult topic for the redeliberation process is worthwhile. And it is now plausible to expect that with the October meeting, the ISB will enter into the decision-making phase on the participating contract. This is really the last and final item for discussion, barring the discussion on transition and the decision as to when the effective mandatory date will be. All these things, based on the new work plan that has been published on Friday last week, will be completed this year. So by December board meeting, we should know all these remaining details. We should know what the participating contracts model is, and also when the effective mandatory date of the standard will be. Deloitte believes that the balloting process that begins after the last decision-making session is completed would take around 4 months. So we would then look at the late April publication as the possible date for this new standard to come out, and we should probably familiarize ourselves, giving where the leasing standard is at the moment as a project. It's likely that the next number in the IFRS series will be taken by the new insurance contract standard, so we will be talking fairly soon about IFRS 16 as the IFRS 4 Phase 2 standard. One final point I wanted to make before opening the floor for questions is that there was a noteworthy decision from the Financial Accounting Standard Board in America on their meeting on the 27th of August, which appears to have tentatively introduced a current measurement basis to account for long-duration insurance contracts, where in the past US GAAP had used a locked-in basis. This is the beginning of the FASB project to approve a series of targeted improvements for the accounting of long-term, long-duration insurance contracts. And it was a rather surprising decision because it appears to be moving in the same direction as the new IFRS. So we will continue to observe the developments of FASB, and together with our American colleagues, will produce some helpful collateral that will help our clients around the world who are interested in the US GAAP developments to appreciate the direction of travel that FASB appears to have now taken on their targeted improvement project for insurance contracts. That being the last point for today's webcast, I'll just take you to the last slide and invite my team to stop the recording and open the floor for any questions.